Hello and welcome. In today's video, we're breaking down personal loan credit score requirements, what lenders look for and why it matters. If you've ever wondered what credit score you need for a personal loan, or what minimum credit score for loan approval most lenders expect, you're in the right place. We'll also explain credit score ranges, the FICO score breakdown, how different scores can affect your interest rates and loan terms, and share what else lenders consider when you apply. Finally, we'll give you some tips to improve your credit score so you can boost your approval chances. This will be an informative, step-by-step guide in plain English, so let's get started. Before we talk about loans, let's quickly cover what a credit score actually is. A credit score is a three-digit number, typically ranging from 300 to 850, that lenders use to gauge how creditworthy you are. In simple terms, it reflects how reliably you've managed debt in the past, things like credit cards, auto loans, or mortgages. Higher scores indicate a history of responsible credit use, while lower scores can signal past issues like late payments or high debts. In the US, the most commonly used credit score model is the FICO score, and most lenders will check your FICO score when you apply for a personal loan. There's another model called Vantage Score, but FICO is the one used by the majority of banks and loan companies. The key point is that your credit score summarizes your credit history into one convenient number, and that number can make or break your loan application. You don't need to be a finance expert to understand your score, but it helps to know the basics of how it's determined. A FICO credit score is calculated from several factors in your credit report. The most important factor is payment history, whether you pay your bills on time, which makes up about 35% of your score. The next big chunk is amounts owed, often measured by your credit utilization ratio, how much of your available credit you're using, contributing around 30% of your score. Other factors include the length of your credit history, longer is better, your new credit inquiries, too many new accounts or credit checks can hurt, and your credit mix, having a variety of credit types, like a mix of credit cards and loans, can help. You don't need to memorize the percentages, but do remember that paying on time and keeping balances low are the two biggest drivers of a healthy credit score. Now that we know what a credit score is and how it's formed, let's look at credit score ranges and categories and see where you might stand. Not all credit scores are created equal. Lenders generally interpret your score based on categories or ranges. For FICO scores, 300 to 850 scale, here's a common breakdown and what it means. Excellent, 800 to 850. Exceptional credit history. You're in the top tier, which shows lenders you are a very low-risk borrower. Borrowers in this range typically have no trouble qualifying and enjoy the best interest rates. Very good, 740 to 799. Very strong credit behavior. This tells lenders you're a low-risk borrower and you should qualify for most loans with favorable terms. Good, 670 to 739. This is solid credit that meets most lenders' minimum requirements. You should qualify with many mainstream lenders, though maybe not with the absolute best rates. Fair, 580 to 669. This is below average. You may still qualify for a personal loan, but likely at higher interest rates and with fewer options. Lenders see some risk in this range, so approvals aren't guaranteed. You might need stronger finances in other areas to compensate. Poor, 300 to 579. This is a low credit score. If you're in this range, you'll likely face limited options or even declines for unsecured personal loans. Few traditional lenders approve loans to scores this low without additional conditions. You might need to improve your score or look at special loan programs if you're here. Another way to think of it, a good credit score is generally anything around 700 or above, which is where you start qualifying for better rates and terms. And scores of 800 plus are considered excellent or exceptional. A score that high means you've proven yourself to be an extremely reliable borrower. On the other end, if your score is very low, say in the 500s or below, lenders consider you a high-risk borrower. Don't be discouraged if you have a lower score. It just means you might have to work a bit harder to find a willing lender or pay higher interest until you can improve your credit. So, why do lenders care so much about that little number? In a nutshell, your credit score helps lenders predict the likelihood that you'll repay the loan on time. It's a measure of risk. A strong credit score signals to the lender that you've handled debt responsibly in the past, making you a more attractive, lower-risk borrower. A low score, on the other hand, can indicate past issues like missed payments or high debt, which means you're seen as a higher risk. Lenders use this information to make decisions about your loan. Here are a few specific ways your credit score impacts your personal loan application. Approval odds. Your score can determine whether you get approved or declined for the loan in the first place. Every lender has its own cutoff, but generally, higher score equals higher chance of approval. Interest rate. Your credit score heavily influences the interest rate APR you're offered. A higher score usually earns you a lower interest rate, meaning you'll pay less money in interest over the life of the loan. Conversely, a lower score means the lender will likely charge a higher rate to offset their risk. We'll dive deeper into rate differences in a moment. Loan amount and terms. Your score can also affect how much money the lender is willing to lend you and the repayment term you get. With an excellent credit score, a lender may offer you a larger loan amount and longer repayment period. With a fair or poor score, they might approve only a smaller loan and/or require you to repay it faster, sometimes to limit their risk. In some cases, a low score could mean additional conditions, like needing a cosigner. In short, lenders rely on credit scores as a quick snapshot of your financial trustworthiness. It's one of the first things they check, but it's not the only thing. In fact, your credit score is one, but not the only factor lenders use to decide your loan approval and terms. This brings us to the next important topic. Aside from credit score, what else do lenders look at in your application? While your credit score is key, lenders will tell you it's not everything. Meeting a lender's minimum credit score requirement doesn't automatically guarantee approval. Most lenders do a holistic review of your financial situation. Here are the other common factors lenders consider on a personal loan application. Credit history length and depth. This goes beyond the score number. Lenders like to see that you have a track record of using credit over time. They may check how many years you've been building credit and how many accounts you've managed. A longer, well-established credit history with multiple accounts, credit cards, car loan, etc., paid on time makes them more confident. Some lenders even state a minimum required credit history, e.g., 2 or 3 years, for applicants. Income and employment. Lenders want to be sure you have a steady source of income to repay the loan. They might ask for pay stubs, W-2s, bank statements, or tax returns to verify your income. Stable employment or consistent income, whether from a job or self-employment, reassures them that you can afford the loan payments. Some lenders have a specific minimum income requirement, while others simply want to see that your income is enough relative to the loan amount. Debt-to-income ratio, DTI. Your DTI is your monthly debt obligations divided by your monthly gross income, expressed as a percentage. It measures how much of your income is already committed to debt payments. Lenders use DTI to assess if you can handle a new loan on top of what you already owe. A lower DTI, meaning you have relatively little debt compared to your income, is better. If your DTI is too high, some lenders may worry that an additional loan could stretch your budget too thin. Free cash flow. This is a concept some lenders use that goes hand in hand with DTI. Even if your DTI is moderate, lenders know you have other expenses, rent, groceries, etc. Some will examine your bank statements to see how much cash you typically have left after all expenses each month, effectively checking your discretionary income. The more free cash flow you have available, the more comfortable the lender will feel that you can handle loan payments. Collateral for secured loans. Most personal loans are unsecured, no collateral required, But if you're applying for a secured personal loan, less common. The lender will also consider the value of your collateral. For example, some credit unions offer share-secured loans, or you might use a car or savings account as collateral. Having collateral can sometimes compensate for a lower credit score because it reduces the lender's risk. Other factors. Lenders may look at your recent banking history, any recent bankruptcies or delinquencies on your credit report, and even credit utilization, how much of your available credit you're using on credit cards. If you're a current customer of the bank or have a relationship with them, that can sometimes help too. A bank might be a bit more flexible if you've been a long-time account holder in good standing. Each lender weights these factors differently. Some online or fintech lenders might focus more on your free cash flow and less on credit score, for example, whereas a traditional bank might have a hard cutoff on credit score, but be stricter on income documentation. The key takeaway is that while your credit score is very important, it's not the whole story. Strong income, low debts, and a solid credit history can sometimes help overcome a marginal score. And vice versa, even with a great credit score, if you don't have the income to support the loan payments, a lender could still decline your application. Now, with that context in mind, let's address the big question. What credit score do you actually need to get approved for a personal loan? One of the most common questions is, what's the minimum credit score for a personal loan approval? The truth is, there's no single universal number. It varies by lender and loan type. However, we can talk about typical ranges. According to a recent survey of personal loan lenders, the typical minimum credit score needed to qualify falls somewhere in the 550 to 660 range. In credit score terms, that spans the upper end of poor through the fair band. In practical terms, many lenders want to see at least fair credit, around the mid-600s, for a personal loan. For example, some banks and online lenders set their minimum around 600 to 620, and a number of lenders won't approve a loan if your FICO score is below that 600 mark. Other lenders are a bit more lenient and will go into the upper 500s. Typically, you'll need a credit score of around 610 to 640 or higher to have a good shot at approval. If you're below approximately 600, your options narrow to specialized lenders or loans with higher rates. Remember, these are general guidelines, not hard rules. Every lender sets its own credit score cutoff. Some might advertise 580 minimum score required, while others might say 660 plus only. And importantly, meeting the minimum score doesn't guarantee approval. It just means you've passed one hurdle. You could meet a lender's minimum score but still be denied because of something else, like insufficient income or too high a debt load. On the flip side, if your score is below the typical minimum, don't lose hope completely. There are a few personal loan lenders that target bad credit loans and might consider scores in the low 500s or even below 500, but be prepared for major downsides. We'll talk about those in a moment. Generally, if your score is significantly below 580, it may be very hard to get an unsecured personal loan from a mainstream lender. And if it is possible, it will likely come with extremely high interest rates, often not worth it. Which leads us to, we just discussed the bare minimum ranges. Now let's talk about what score you should aim for to not only get approved, but to get good loan offers. Most lenders prefer to see a credit score in at least the good range or higher, usually around 670 and above. If you're at 670 plus, you're typically considered a lower risk borrower, and you'll have more lenders competing for your business. This means not only easier approval, but likely better rates and higher loan amounts offered. In fact, for the very best interest rates and terms on personal loans, you generally need a score in the mid-700s or above. Lenders reserve their most competitive rates for those with very good to excellent credit. Think 740 plus in FICO score. If you're in that range, you've proven your creditworthiness, and you'll often see lenders advertising their lowest APR as low as X%, which typically only applicants with top-tier credit will actually get. Now, What if you are below that ideal range? Say you have a fair credit score in the 600s or a poor score in the 500s. Can you still get a personal loan? The answer is yes. It's often possible, but it comes with trade-offs and limitations. We'll discuss those next. Before that, a quick note. Some lenders specialize in different segments. There are lenders who cater to people with excellent credit, prime lenders, and others who market to those with lower credit or limited credit history, subprime or second chance lenders. So if your score isn't great, you might need to seek out lenders that advertise willingness to work with fair or poor credit. And if your credit is excellent, you can be more selective to find the lowest rate. Always remember, each lender's criteria is a bit different. So, what credit score lenders look for really depends on which lender you're talking about. But aiming for a good or better FICO score, 670 plus, will give you a comfortable cushion for most personal loans. Let's address the scenario for those with less than stellar credit. If you have a fair credit score, 580 to 669, or poor credit, below 580, getting a personal loan is certainly possible, but you should be prepared for a few things. Higher interest rates. With a fair or poor score, if you do qualify, it will likely be at the high end of the lender's interest rate range. Personal loan APRs can vary widely. For excellent credit, rates might be in the single digits or low teens, but for bad credit, you could see offers with annual percentage rates near 30% or even up to 36%, the typical maximum for many lenders. In fact, borrowers with credit scores under BAO 550 often cannot qualify for a loan with an APR under 36% at all. 36% APR is considered the upper limit of affordable loans by most consumer advocates. A low score means you'll pay much more interest, making the loan more expensive. Smaller loan amounts. Lenders might limit how much they'll lend you if your credit is shaky. You may only qualify for a lower loan amount until you prove you can handle it. For example, instead of $10,000, a lender might approve you for only $3,000 or $5,000 with poor credit. They want to minimize risk exposure. Shorter repayment terms. Similarly, a lender may offer a shorter time to repay, higher monthly payments, if they view your credit as a risk. A shorter term means they get their money back sooner. This isn't always the case, but it can happen with subprime loans, e.g. a 2-year term instead of 5 years. Additional requirements or documentation. You might be asked for more proof that you'll repay. Lenders could require extra paperwork, like more income verification, references, or even ask for a co-signer with good credit to guarantee the loan. A co-signer is someone who agrees to sign the loan with you and take over payments if you default. Having a willing co-signer can sometimes get you approved or help get a slightly better rate when your own credit isn't strong. Not all lenders allow co-signers, but many do for this reason. Collateral, secured loans. If unsecured options aren't available, you might consider a secured personal loan where you put up collateral, like a car title, savings account, or other asset, to back the loan. Some lenders or credit unions offer share-secured or certificate-secured loans for members with poor credit. Providing collateral can significantly improve your chances since the lender has something to fall back on. But be very careful. If you fail to repay a secured loan, the lender can take your collateral, repossess the car, for example. Only pledge collateral you're prepared to potentially lose if things went wrong. Fewer lender options. Fewer mainstream banks will approve loans for low credit scores. You may have to look at specialized online lenders, peer-to-peer lending platforms, credit unions, or even consider alternatives. Be cautious. Some no-credit check or payday loan companies will lend to anyone, but they often charge extremely high interest, sometimes triple-digit APR, and have short payback periods. Those can create a debt trap. Always read the fine print and exhaust safer options first. The good news is, some lenders do look beyond just the credit score number. For example, many credit unions are known to be more flexible. They might consider your overall membership history, your income, and reason for the loan, rather than strictly enforcing a high credit score requirement. There are also lenders that advertise specifically to fair credit borrowers who may evaluate things like your employment or education in addition to the credit score. If you find yourself in the fair or poor credit range, it's wise to shop around carefully and perhaps start with institutions you already have a relationship with. And very importantly, consider whether taking a high-interest loan is truly necessary or if it can wait. Because those high rates will cost you a lot in the long run, sometimes it might be better to spend a few months improving your credit first, if feasible, before borrowing, which leads perfectly into our next section on how different credit scores affect your rates and what you can do to improve. We've mentioned a few times that credit score influences your interest rate. Let's paint a clearer picture of just how much it can affect the cost of a personal loan. Lenders typically tier their interest rates by credit score ranges. One analysis of personal loan offers in mid-2025 showed the following average APRs by credit rating. Excellent credit, 720 to 850, approximately 13.3% APR on average. With excellent credit, you qualify for the lowest rates. Some lucky borrowers might even get single-digit interest on a personal loan. Good credit, 690 to 719, approximately 16.5% APR. Still a decent rate, though a bit higher than the excellent range. Good credit borrowers pay somewhat more, but loans are still quite affordable. Fair credit, 630 to 689, approximately 20.2% APR. Now we're getting into significantly higher interest. A fair credit borrower might pay around 20% on a personal loan, which will increase the monthly payment and total interest paid. Bad credit, 300 to 629, approximately 20.6% APR. Interestingly, this data showed that the average for bad credit wasn't much higher than fair. But keep in mind, many in the lowest end of this range likely couldn't get approved at all, so this may reflect those on the higher end of bad. In reality, if your score is, say, 520, any offer you get might be at the maximum APR, often 30% plus. And as we noted, a score below just 550 might not get an offer from a lender that caps APR at 36%. You'd be looking at potentially predatory loans above that rate, which are not recommended. These numbers are averages, but they give a sense. Dropping from a good score to a fair score could mean paying a few extra percentage points in interest. That can really add up on a multi-year loan. For example, borrowing $10,000 for 3 years at 10% versus 20%, the 20% interest loan would cost you thousands more in interest by the end of the term. Also, as mentioned earlier, a low credit score could result in the lender offering a shorter loan term or smaller amount than you originally wanted. To sum it up, your credit score directly affects how affordable or expensive your loan will be. A higher score saves you money with lower interest and often gives you more flexibility. Higher loan amounts, longer terms. A lower score does the opposite. It makes borrowing costlier and options more limited. This is why it's often worth delaying a loan application for a bit and trying to improve your credit score first, if you can. Speaking of which, let's go over some practical tips to boost your score. If your credit score isn't where you want it to be right now, don't worry. Credit is not static, and you can improve it over time. It's best to start working on improvements before you need a loan, because meaningful changes can take a few months or more to reflect on your score. Here are some tried and true tips for raising your credit score. 1. Pay your bills on time, every time. This is the #1 factor in your credit score. Your payment history makes up about 35% of your FICO score, so late payments are extremely damaging. Even a single payment over 30 days late can knock your score down significantly, sometimes by 100 points or more. Set up automatic payments or calendar reminders to ensure you never miss a due date. If you tend to forget, consider aligning payment due dates with your payday or ask creditors to change the date to better fit your schedule. Consistent on-time payments over time will steadily boost your credit. 2. Reduce your credit utilization. Pay down debt. The second biggest component is how much of your available credit you're using. This mostly applies to revolving credit like credit cards. Your credit utilization ratio is the percentage of your credit limits that you've used. Try to keep it below about 30%, and lower is better. For example, if you have a total credit limit of $10,000, keep balances under $3,000. Paying down existing balances will lower your utilization and can improve your score. Alternatively, you can sometimes request a credit line increase to increase the denominator. Just don't use the new credit. Either way, lowering utilization can give your score a quick uplift. 3. Check your credit report and dispute errors. Mistakes on credit reports are more common than you might think, and they can drag your score down unfairly. You are entitled to free credit reports. In fact, you can get all 3 bureau reports, Equifax, Experian, TransUnion, for free at annualcreditreport.com. Review your reports for any errors, accounts that don't belong to you, incorrect balances, or outdated derogatory marks. If you find something wrong, file a dispute with the credit bureau to get it corrected. Fixing a credit report error can sometimes instantly recover points that you lost due to no fault of your own. 4. Limit new credit applications. Each time you apply for credit and the lender pulls your report, it can put a hard inquiry on your report, which might ding your score a few points. Lots of inquiries in a short time can signal risk and potentially hurt your score. So, if you're in credit building mode, try not to apply for new credit unnecessarily. When rate shopping for a loan, do it in a focused period, like 2 weeks, so multiple inquiries count as one for scoring purposes. And avoid opening new accounts right before you plan to apply for a major loan if possible. 5. Keep old accounts open, lengthen credit history. The age of your credit accounts matters. Older accounts show a longer history. If you have credit cards or other accounts you don't use much, it may be beneficial to keep them open. Perhaps use them occasionally for a small purchase and pay it off, rather than closing them. Closing old accounts can shorten your average credit age and reduce your total available credit, which can raise your utilization ratio. As long as they have no annual fee or downside, older accounts can contribute positively to your score by adding age and extra credit limit headroom. 6. Consider credit building products if needed. If you have a very thin credit file or need to rebound from a low score, there are special products to help. One is a secured credit card, which you can get by paying a deposit to the issuer, then use it sparingly and pay on time to build positive history. Another is a credit builder loan, often offered by credit unions or fintech companies, which is a small loan where the money actually stays in a bank account until you've made all payments. Then you get the money, and the payments are reported to bureaus to build credit. These are designed for building or rebuilding credit and don't usually require good credit to open. They might not even check your score. Over 6 to 12 months, these tools can add some positive payment history to your credit report. Additionally, if you have a friend or family member with excellent credit, becoming an authorized user on their credit card can sometimes help boost your score. You'll piggyback on their credit history for that account. Make sure they use it responsibly. Their good habits can benefit you. Remember, improving your credit is a marathon, not a sprint. Quick fixes are rare, apart from correcting true errors. But even a period of a few months of good behavior can start to move the needle upward. And if you can take 6 months to a year to really polish your credit before applying for a big loan, you could save yourself a lot of money in interest by qualifying for a better rate. The effort you put into raising your score is absolutely worth it when it comes time to borrow money. It directly translates into real dollars saved. We've talked a lot about credit scores and requirements. To wrap up the practical side, here are a few smart steps to take before you actually submit a personal loan application. Review your credit reports and scores. This is a must-do first step. Check where you stand, get your current credit score, and see what's on your credit reports. Knowing your score will help you target the right lenders. For example, if you discover your score is 610, you might avoid applications to lenders who require 700 plus. It also lets you catch any errors or last-minute issues you might fix. You can use free resources or your bank's score monitoring or services like Credit Karma, though note that some free scores are Vantage Score, not FICO, but they're usually in the ballpark. Use pre-qualification tools. Many lenders offer a pre-qualification or check your rate feature online. This lets you see if you might qualify and what rate you'd get without a hard credit inquiry. It's typically a soft pull that doesn't affect your score. Using pre-qualification, you can shop around and compare offers from multiple lenders safely. It's a great way to gauge your chances and find the best offer available for your credit profile before committing to a full application. Compare loan options. Don't grab the first loan offer you get. Compare interest rates, but also look at any fees, like origination fees, the repayment term, and monthly payment. Sometimes a slightly higher rate but longer term could mean a more affordable monthly payment, or vice versa depending on your goals. Make sure you understand the total cost of the loan. Websites like NerdWallet or Bankrate can help compare personal loan lenders, and pre-qualification results will give you specifics to compare. Have a repayment plan. Before taking on new debt, factor the loan payment into your budget. Ensure you're comfortable that you can pay it each month. If you're consolidating other debts with this loan, account for those payments being replaced. The idea is to set yourself up for success. Remember, missing payments will hurt your credit score, undoing progress made. So choose a loan amount and term that keeps payments manageable. Consider timing. If you're right on the cusp of a better credit tier and this loan isn't an emergency, consider waiting a bit and improving your score. For example, if a quick paydown of a credit card could boost your score from 660 to 670, moving from fair to good, that might get you a better rate. Timing your application after a positive change or after a negative mark ages a bit more can be strategic. Also, try not to apply for multiple credit products simultaneously. If you're buying a car or house soon, keep in mind how those might collide with a personal loan application. Space them out if possible. Remember, your credit score is just one part of the picture, albeit a very important part. Lenders look at the whole financial picture, so controlling what you can, your credit, your debts, and preparing documents to show your income will put you in the best position. By now, you should have a clear understanding of credit score requirements for personal loans and what lenders are looking for when you apply. Let's quickly recap the key points. Credit score basics. Your credit score, typically FICO 300 to 850, is a major factor in loan approvals. It sums up your credit history into one number that indicates your risk level to lenders. Score ranges. We broke down the FICO ranges from poor to excellent. Generally, 670 plus, good, is where you start to have strong approval odds. 740 plus gets even better terms, and 800 plus is excellent credit. Scores below approximately 580 are considered poor and will make loan approval challenging. Lender preferences. Most lenders prefer at least fair to good credit, mid-600s or higher, for personal loans. Some lenders have minimum scores around 600 or 620, while others may accept down to 580 or even lower, especially with compensating factors. The exact requirement varies by lender, so it pays to shop around. Beyond the score. Your credit score alone doesn't seal the deal. Lenders also evaluate your income, debt-to-income ratio, credit history length, and sometimes other factors like your cash flow or relationship with the bank. All these help them decide if you can and will repay the loan. Score impact on loans. Your credit score heavily influences your interest rate and terms. Higher score equals lower interest and often higher loan amounts. Lower score equals higher interest, sometimes dramatically higher and possibly smaller, shorter loans. For example, good credit might get a personal loan around 10 to 15% APR, whereas bad credit could see 25 to 30% plus APR. That can mean paying a lot more for the same loan amount. Low credit options. If you have fair or poor credit, you can still get a personal loan, but expect trade-offs. You might need a cosigner or collateral, you'll pay higher rates, and you'll have fewer lenders to choose from. Be cautious of any no-credit check loans as they often come with predatory terms. It might be worth improving your credit first if the loan isn't urgent. Improving your score. We provided several tips to boost your credit. Pay on time, no exceptions, reduce your debts or utilization, correct any credit report errors, be prudent with new credit inquiries, keep old accounts open for history, and consider tools like secured cards or credit builder loans if needed. Even a moderate improvement in your credit score can significantly expand your loan options and save you money with better rates. Preparation. Finally, go into any loan application prepared. Check your credit beforehand, use pre-qualification to gauge offers, compare lenders, and know how the new loan fits your budget. This preparation will increase your confidence and odds of success. We hope this deep dive has demystified personal loan credit score requirements for you. Knowledge is power. By understanding what lenders look for, from your credit score to your overall financial picture, you can take steps to meet those requirements and secure the loan you need on the best possible terms. Remember, building and maintaining a good credit score is a journey, but it's one that pays off whenever you need to borrow. So keep practicing those good credit habits, and you'll be in great shape the next time you apply for a personal loan or any credit product. Thank you for watching. If you found this information helpful, please give it a thumbs up and consider subscribing for more personal finance tips. Feel free to ask questions or share your own experiences with personal loan applications and credit scores in the comments below. Good luck with your loans and your credit journey, and until next time, stay financially savvy.